and welcome to a special Market Masters edition that coincides with the end of the second quarter earnings season. The question we're asking our guests is whether the results season shows a clear recovery in Indian earnings and hence will the foreign investors return. Our guest today is Timothy Moe, co-head of Asia Macro Research and Chief Asia Pacific Equity Strategist at Goldman Sachs. We have invited him because Goldman Sachs has just turned overweight on India from their underweight position almost 13 months ago, since October 2024. Timothy, thank you very much for coming into our studio. That's
thank you
making
very
it
much.
all the better. Okay, well, straight away, why have you turned overweight on India?
Really, Latha, the reasons are that the causal factors for engendering our downgrade 13 months ago, as you mentioned, have dissipated and look as though they're turning aside. So to be specific, we downgraded for two main reasons. One, that a lot of India's good news got priced into the market valuation in September, October of last year, when the market was trading about 25 times forward earnings. So we've been very positive in India, as many people have been, but felt a lot of that was in the price. So that was number one. And number two, we had a developing conviction that there would be what we were terming a mid-cycle slowdown in the economy and in earnings. And as I'm sure you're aware, when you have a richly priced stock meeting a downgrade, you tend to get some hyperactive move to the downside. So we just felt, look, let's step back here and take our foot off the accelerator and take our view down. And we're fortunate that our timing was reasonably apt. And since then, India has underperformed by the most in a decade or two, particularly compared to China, which has come out of its doldrums and has had a very good year. So if you look at the scorecard for year-to-date market performance, China's up 35%, and India just recently was up only 2-3% in dollar terms. And that's MSCI India, but Nifty pretty much the same. So what we figured, to your question, is, well, number one, there's been some moderation in valuation. Not colossal, but the market was coming down to maybe 22 times. So it kind of grown into its valuation to some extent. Number two, quite clearly, the economy had slowed down, but was showing signs of stabilization. And in fact, even has printed above expectation numbers for second quarter of calendar year, first quarter fiscal year. And we've been toning up numbers overall. And then at the market level, there's clear signs that the persistent downgrade cycle for earnings has really stabilized. If you look, for example, at a measure of breadth, number of analysts downgrading versus upgrading, and this is your zero line, we got to really, really deep. Almost everybody was downgrading. Now it's basically flat, and even there's a touch of upgrades. And if you look at the most recent quarter, which you mentioned, the expectation coming into that was about 9% year-on-year growth for the full market. It's actually going to come out more like 14, about 5 percentage points above. So there are signs at the earnings level that things are coming into play. So you put all that together, and we just feel that the risk-reward for India is now turning more favorable, especially because foreign investors have sold, since they started selling last year, about $30 billion in this downgrade, this down selling time, which is the second largest in absolute terms and relative to market cap on record. And even year to date, there's about $16 billion in net selling, which has gone on. And so if you've got lighter foreign positioning, you've got an economy which is stabilized, looks like it's picking up a little bit. Earnings, we think, will grow on a compound basis, maybe 13-14% next couple of years. Market valuation is still rich, but acceptable. We did a bunch of work on that. We just feel risk-reward looks better for India. So we figured it's time to pull the trigger.
Very good. That suits us. But which sectors are you impressed with? Are you impressed mostly with consumption? Because that's where the government has given everything it can, rate cuts, tax cuts.
Indeed, Latha. So we very much like the mass consumption theme. So I'll answer your question this way. There are a number of themes that we particularly like, which, as I said, to start with your question, would be mass consumption, because obviously the underlying dynamics, demographics, large population, per capita incomes are rising, people's consumption habits change. This is your classic sort of developing market or developing economy story, and we think that India has much to play for in that regard. Additionally, we like the theme of self-sufficiency, and this plays into defense, into energy sufficiency, and so forth. So there's a lot of aspects there our analysts just did a very large report, 140-page report on initiating on the Indian defense sector. And defense is a theme which we've liked regionally and globally, and I think for many reasons, which I'm sure we'd all agree with.
Yes.
In a fractious geopolitical environment, which we find ourselves in today, the theme of defense is one that's played very, very well. And we think India has some catch-up to go in that. And so we're quite excited about that theme, along with the theme of energy sufficiency. We also like the theme of the new economy. This is leaning into the digital economy and more delivery.
E-commerce.
Correct. Yeah, e-commerce, fast delivery, all that sort of stuff, where you see a transition from your analog to digital economy. It's not a theme unique to India, but there's a lot to play for in that regard. And then just simply the theme of high growth, where we find there are many companies that are offering good growth opportunities, particularly in the smaller mid-cap space, where you've got early emerging companies that tend to do better. So we like those four themes. And then from a sector perspective, that will be manifested in a number of the consumer areas in terms of durables. Some of the financials, the banks have particularly come out of a period of credit constraint. And so we actually initiated an investment view of longing financials versus Nifty. We thought that was an interesting catch-up performance trade for the banks. And then some select higher growth areas as well. So that's sort of our view within the market.
Okay. Just zooming out, what would be your pecking order, since you specialize in all of Asia? What's the pecking order in terms of countries in Asia?
Well, it's a great question, and frankly, we're a bit spoiled for choice here,
good.
because we like a lot, and I think the trouble we're having in terms of finding things that we don't like as much is, I think, an indication that the broader appeal and potential for Asian equities actually still looks pretty good, even after a very strong year. MSCI Asia Pacific ex-Japan Index is up 25% this year, and 40% off the lows in early April. And so we think that can continue into next year for reasons we can explore a little bit later. And as I said, we're somewhat spoiled for choice. So to be more specific, we've had a very, very positive view on Korea, which is the superstar this year.
Because of the AIs.
Yeah, stratospheric performance. It was actually up 90% nearly in dollar terms. And it's had a bit of a correction, but still up roughly 80. And one might think, well, after that, it's probably going to cool off. But even with that significant performance, Korea is still trading at 11 to 12 times earnings. And a good part of that is that, number one, the earnings delivery has been very, very strong because of the AI theme and so forth. But also, we're having a re-rating structurally of Korea because of better corporate governance, which I can get into further if you wish. But the point is that this rally in Korea started literally from 8 times earnings. So even if you're up a lot, you've only reflated to 11, 12 times earnings, which means there could still be plenty more to go for. So we like Korea. We like China. We just put out a view that over the next 2 years, we think China can go up 30% in price terms, maybe another 5% in dividend yield. And again, we think there's some structural reasons there. Taiwan, which are market weight on, but also looks good because you've got a very strong AI component there and some broader tech elements. So North Asia, we think, still looks good, including Japan, by the way.
Okay.
But then India, we like also. Maybe it's a bit early, and maybe it's going to take a little bit of time to catch up, but we like India as well. So those would be our top picks. To balance that out, in an Asia perspective, we're underweight Australia because it's richly valued and doesn't have as much growth. Not that we're necessarily outright bearish, but think it still will perform less well than the others. And then trying to be underweight as much of ASEAN as we can. These are the smaller markets, Indonesia, Malaysia, Thailand, Philippines, and so on, because they just don't have as much of that tech-focused driver.
Yeah. Clearly a developed country choice more. But, the start of this year, not start, maybe after the Liberation Day, after February 1, announcements from Trump, economists actually turned very negative on global growth because of uncertainty. You won't know where to invest in which product because you don't know when you will be hit by how much tariffs. That was the narrative we got. But in your report, you'll have upgraded growth forecasts for practically every region, for the world, for the US, for parts of Euro area, and of course for Asia, in a big way, even for India. Yeah. Why did it change?
So great question. So first of all, we and many other economists are upgrading our forecasts on a fairly dynamic basis, given the information which comes in. And so the point of reference that you took just after Liberation Day was the nadir, the worst part of the forecast, because at that point we were looking at very, very elevated tariffs. And of course, there was this sort of tit-for-tat escalation between the U.S. and China, where you had such colossally high tariffs that it basically was equivalent to an embargo in trade. And of course, that would have been very, very damaging for both economies. So we marked down our growth views dynamically quite aggressively. And just to give one or two numbers, we started this year, taking China as an example, with about a 4.8% GDP growth forecast for the full year. And that got marked down to about 4.1 in early April. But then, of course, as some of that tariff increase was walked back, and in China's particular case, we saw exports doing much better than we had thought, and I think consensus, we progressively marked up our numbers, so much so that today we're actually standing at 5% GDP growth for this year, and we just did the biggest upgrade to our China forecast in probably a decade, adding 50 basis points and 70 basis points to our 2026 and 2027 numbers. Now, because of this leaning into high-tech manufacturing and China's export competitiveness, and also the leverage they've got through rare earths. So the point of all this is that we've seen kind of a walking back of some of the worst fears, number one. Number two, to your question, that sort of reduces at least some of the uncertainty and makes it a little bit better environment for investment. Number three, a lot of that investment has come in, particularly in the U.S., in hyperscalers and AI, which is really separate from the whole tariff area of concern. And then number four, just if you look at the data which has come out, just empirically, the world seems so far to be doing better than one would have thought given the higher tariff levels. So people are just learning to live with it to a better degree. So all of that contributes to that increase in the growth forecast.
What do you think will be the catalyst that other foreign funds will wake up to the change in sentiment over India? Do you think this catalyst could be only the trade deal? Unless that happens, people are not going to come in?
So I think it's a few things, Latha. So if there is an announcement between the U.S. and India, as seems to be rumored, of course the market would look at that as a good thing, because if this extra, for example, 25% tariff surplus is eradicated, and maybe there's even agreement to go to something along the lines of what both Korea and Japan have arranged bilaterally with the United States, which is about a 15% base case, with maybe, in each case, Korea or Japan buying more from the U.S. and then also investing more in the U.S. If there's some sort of agreement along those lines with that sort of flavor, I'm sure the market would take that well. Now, I don't think that the full 25% additional tariff surplus has been fully priced in, because most investors thought, well, it's probably not going to last for a long time. But the market has certainly expressed and priced some sort of concern over that. So if you know for sure that's not going to be there, that's going to be a positive. So I think that in terms of near-term catalysts, that's one which we can look to. But the other ones, I think, from an India-specific perspective, really would be delivery of growth, because I think the broader picture for India is that valuations are full. I mean, 22 times earnings, hard to argue things are on sale. We did a big piece which looks at valuations from a variety of different perspectives, and the punchline is that we think that these valuations are defensible, but we're not calling for an increase here. We think there may be even a little bit modest decrease, but roughly speaking, we could hold on to the current level. Ergo, in order to really power India and to rekindle foreign investor interest, India earnings have to come through. So I think it's really earnings delivery as we go through time will be the catalyst to get interest coming back.
A final question, and this is a macro market conflict I have in my head. India's macros have improved. We were a country up until 2013 with a 6% inflation on average, and because we adopted inflation targeting and went after it, now we have constrained our fiscal deficit, and inflation is averaging about 4%. That is reflecting in lower nominal GDP and probably impacting earnings. But that's a good reason why earnings and nominal GDP are lower, because we controlled inflation. Don't you get brownie points for that? Or do investors like you only look at the earnings number?
No, it's a great question. I concur with you. I think that if you have an environment where you have better real growth or very good and solid real growth and inflation under control, that is a much healthier environment. And I think full credit to India for the fiscal consolidation which has taken place, but it's been done in a gradual manner, so you kind of thread the needle between wanting to be more prudent fiscally without doing so much that you then hurt growth and have a negative spillover effect. So I think that the policymakers have done a very commendable job in that regard. I think that the silver lining, as you said, in that slight cloud of lower nominal GDP is that a lower inflation environment certainly allows the RBI to be more accommodative. And I think it also may calm fears about currency weakness. So if you get a more stable rupee and lower interest rates, well, lower interest rates are obviously good for markets through valuation. So I think that there's that positive pass-through effect from lower rates, which may mitigate the lower.
No, you're right that the inflation differential narrowing so much between India and the US is not reflecting in the currency just yet.
Correct.
But do you think the rupee's worst is over?
So our overall view, as I mentioned earlier, is that the U.S. dollar should weaken on a structural basis. India's had some challenges this year, and the rupee's been on the weaker side, along with the Indonesian rupiah. But we think here it's sort of probably roughly range traded stable. So we don't think it appreciates as much as some other currencies, for example, the Korean won, which I think is very undervalued here. It should rise, and the Taiwan dollar as well. But we think it can sort of hold its own. So I think from a U.S. dollar investor perspective, you're probably okay in U.S. dollar, keeping score in U.S. dollars. And then the real heavy lifting will have to be done by earnings delivery and growth.
Thank you very much, Timothy Moe, for your views and for dropping into our studio today. I do hope other funds follow Goldman Sachs' view and change their view on India and rate it overweight. Well, we have to take a break on that note, but I'm back with another guest on our Market Masters edition. Latha Venkatesh, the chief economist from CLSA, will join us after the break. Welcome back to Market Masters. So, the show where we are asking if India is on the cusp of a re-rating. My guest now is Latha Venkatesh, the chief economist at CLSA. Latha, good morning, and thank you very much indeed for joining us. Well, let me start by asking you that India's second quarter, what we call second quarter, July, August, September quarter, GDP number is due in a week. Has there been a recent upgrade from CLSA? What's the number we should be prepared for?
Yeah, so if you look at the current fiscal year we're looking at growth coming in just a hair below 7%, so 6.9% to be exact, right? So relative to the first quarter of the fiscal year, it does, you can say, imply some slowdown in growth during the remaining 3 quarters of the fiscal year. That sort of slowdown, I would say, is sort of driven essentially by 2 factors. One is because the government has to sort of rein in to some extent, you can say, spending to meet the deficit target. We think there'll be some sort of slowdown on that side, maybe sort of government-led infrastructure type investments. And then also the sort of, should we say, lagged effect of the higher tariffs that got imposed on India from the US, and also a slowdown we're seeing in global trade in the, should we say, in the incoming quarters as well, would be the 2 factors that will drive that. I guess if we start to see the effect of some of the GST reform, that could provide a bit of a lift to the consumption side of things, right? So that's why the slowdown we are looking at in the remaining of the fiscal year is not that significant. So as I said, full year fiscal at 6.9%.
Would you put an upward bias to that 6.9 because of the GST cuts and the probability of a trade deal with the US?
Yeah, certainly, I think the chances of a trade deal have gone up, right? I mean, Trump has certainly indicated as much, and the 2 sides are still negotiating on that front, right? So whether it happens on this in this calendar year or in the beginning of the next calendar year, so the last quarter of the fiscal, we'll have to see, right? But I suspect that we could move towards a deal, right, where maybe the tariff rate that's imposed on India lands at something similar to what we're seeing for other Asian economies, to say around 20% thereabouts, right? And then, of course, there'll be some give and take also in terms of purchases and opening up for certain sectors, that will be part of that broader deal, sort of in similar fashion, but not quite the same as we've seen from some of the other Asian economies, right, where they've entered deals with the US.
Okay. Well, is there any, this is not really an economist's question, it's more your equity strategist question, but do you see the global view on India changing? We've seen the largest amount of foreign investment outflows from India.
Yeah.
But
Yeah.
now, as you know, the GST cuts and the income tax cuts in India work in and earnings improve, and probably the trade deal comes in, do you see the movement of funds back into India? I mean, a lot of the rupee depends on that. That's why I'm asking.
Yeah. I mean, so I think given our view on, should we say, US equities being quite frothy, right? And should we say a little bubbly, if you will, right? I mean, we do also see a relatively high probability of a correction in US equities, and that also would imply, should we say, more of a sort of less risk appetite, more broadly speaking, globally, right? So I think it will be hard for Indian equities to sort of buck the trend in that type of environment. But if you look, should we say, beyond that potential correction, and if there's also maybe some further correction in India in the context of that as well, right? And valuations are maybe somewhat less, should we say, challenging to the extent they are now, then maybe there could be a bit more scope if we start to see the GST reform adding to the growth impulse in India, right? And if growth holds up relatively well, that there could maybe be some resumption on the other side of this of equity investors coming in, right? But I think valuations still are quite high. I think positioning domestically is still quite long in the tooth as well, right? So I think that is still something that does pose, I guess, challenges from the point of view of foreign investors in the near term, right? So maybe a healthy correction could be a good sort of starting point, right, for seeing flows coming back in.
Okay. Well, just a final word. How many rate cuts do you see from the Reserve Bank? Is it just one in December or, more?
So we currently have two. 25 basis points in each of the two following meetings, right? So we're not buying it. We're not looking for 50 basis points in December, which I think came up after the latest inflation number, right? But I think what you need to look at is if you look at core inflation, right, in India, it's still at around the target, right? So I don't think there's necessarily a case for cutting by 50. So 25 basis points in December, and then subsequently another 25 basis points.
Okay, got that. Thank you very much, Lee Feskison, for joining us and giving us a view of both the US economy, the global economy, and where Indian rates are headed. Thank you very much for joining us in this special edition of Market Masters.